All right, I can thank you everybody for being here. It's the February the 18th. It's hard to believe the month of February is more than half over now. Hope everybody's still staying warm with all the weather that we've had over the last couple weeks. So we're going to go ahead and start the town hall today. And Deanna, do you want to do ladies first or would you
It
defer to
doesn't
the
matter.
gentlemen?
It really doesn't matter.
So then we're going to go ahead and kick off and let Miss Deanna go ahead and start the town hall tonight.
Okay, let me see if I can share the right screen. Um, Wanted to talk a little bit about the low interest rate environment and what's going on with the stock market. And you've heard us talk about this before, but it's worth repeating because growth stocks are still, climbing with some volatility and with low rates and the challenge of trying to find income in a low interest rate environment, more investors are going into stocks. And I wanted to share with you how the Fed's actions affect stock valuations that can potentially put your portfolio in danger. You just want to be aware of it and how it could potentially, as the economy recovers, how that could impact you if you're too heavily weighted in certain areas of the market as well, particularly growth stocks, which tend to make up a majority of 401ks, at least the ones that we tend to um, do analyses for here. We see them heavily weighted in growth stocks. So that's something you want to be aware of. You may want to take some of those gains off of the table if you're seeing some record highs there. I'm seeing in the double digits in some folks' portfolios. And it's just something to be aware of because when the Fed is loosening the money supply, it's doing a couple of things. It cuts the federal fund rate, and that lowers the interest on all debt. So that includes loans, mortgages, bonds. Um, Companies can borrow money to expand their businesses on the cheap. But there's another lesser known effect of these low rates is that it increases the theoretical value of stocks. I'll show you another slide here. So stocks are generally priced upon earnings expectations, and it's the present value of the money the company will make in its lifetime. So, but the calculation is based on the discount rate, and in a lot of cases, and the company will make some of that money in a distant future of like 20, 30 years from now. So if you're tallying up future cash flows and then discount them based on when the company is expected to make that money, it's going to drive the price of that stock higher. So the discount rate is a whole other layer deep on how stocks are valued. But basically, it looks like this. um, what we're seeing here is this hump in stock valuations. And the bottom part of stock prices, this is driven by fundamentals, a recovering economy and earnings. But the upper part in red that you see, that is the valuations that are being artificially propped up by the Fed's loose policy. And this is where the biggest danger to your portfolio lies, is when we will see a correction in that. So as the economy improves, the upper part is going to start shrinking. In fact, not even if, but it's more likely when the economy improves, because the Fed's job is to keep two things in check: stable prices, that's the average inflation, and maximum employment. That's their two guardrails. And so if when the Fed believes the economy can achieve these without handholding, they're going to start raising those interest rates and the fund rates. And you want to keep a close eye on the Fed as they're doing that, because that's when you're going to start seeing those valuations shrink. And the stock market isn't the economy, but a lot of its side effect is from the Fed's response to the economy. So it's just something I wanted to share. We certainly cannot predict the future, but we certainly see some red flags here. And here's another chart is just showing where the S&P is, and then the red line is showing the 10-year treasury yields. So there's a big spread there. But when this treasury line starts climbing, the stock valuations, particularly in growth stocks, could start going back down. So I'm going to stop sharing here. And the point is that today it's difficult to make a decent return safely. 6 or 7 years ago, you could buy 3 to 5 year treasuries and get 6%. You could have safety and income, but we have to make a difficult choice of safety or income, or trying to ride that middle threshold and still balance your risk adjusted returns. It's much more challenging with the rates being suppressed by the governments. So there's no free market going on right now in money today. Interest rates aren't natural. So it's just something to be aware of when interest rates are being manipulated. You're going to have some challenges in how the market responds with its valuations. Free markets optimize the allocation of the resources in the long run. And when you're manipulating that, it distorts the values and the allocation of resources. So it was necessary. It's necessary to prop up the economy, but you've got to watch out for that greed factor of thinking you're going to be making double-digit returns in your stock or your equity portion of your portfolio. So just something to be aware of.
Thank you, Miss Deanna. Mel, are you there? Or
I am here. I'm trying to get the camera to work. There we go. I'm not really using fuzzy thinking here, but I do have a problem with this particular camera going in and out, and we forgot to replace it this week. I have a few things. I'm going to go back and revisit some of the things that I talked a little bit on our last town hall about using what we call the LIRP plan, or the Index Universal Life Policy. And there's just a few aspects of that. Now, the rule of law that affects this particular code with the IRS is called 7702, which I mentioned last time. But what are some of the benefits of using an indexed universal life insurance policy as a part of your retirement planning? It's not a panacea. It's not better than stocks or better than a 401k or a Roth or things of that nature, but it can have quite a few different benefits built into it that those other items may not have. And it could be a very strong part of an overall retirement planning structure. For one thing, it has an instant legacy for your heirs. If I have an IRA or a Roth or an investment account and I die, my heirs collect that day's value. Now, next week, that value could be higher or it could have been lower, and I may spend out of that account. And then I have to consider the taxability of spending out of those accounts. But with life insurance, one of the major components of it is a tax-free death benefit. So it enhances the legacy value instantly. Because if I plan on putting a certain number of payments or deposits into an indexed universal life policy, and I've placed 1 or 2 or 3 payments in, the full death benefit belongs to my heirs instantly. Whereas if I'm comparing that to what a Roth conversion or investment philosophy might be in the future, I have to wait that appropriate amount of time for it to catch up to the instant value that the life insurance has. That's one thing. The second one is called the power of indexing. And the power of indexing, if you have an annuity with us, you probably have a fixed indexed annuity where in the negative years when the index is down or the market is down, we do not suffer losses. And when the markets are doing well, then we make money. And we may not make all of the potential upside, but we want none of the potential downside. So we live in that corridor with the fixed indexed annuity. Sometimes it beats the investment, sometimes the investment beats it. It all depends over what time frame you're looking at. But the primary function is not to lose the principal. Well, with the indexed universal life policy, we have a component of that same issue in that we can use the S&P or other indexes. And in bad years, we have no negatives. In good years, we have a potentially higher rate of return that we might get in a traditional life insurance policy. So we have more upside. Now, granted, you have to be aware that upside is a expectation of results in the future, and the past can't really guarantee that, but it does act as a bit of a predictor. And we tend to run our projections and illustrations at a lower return level than what we've experienced in the past as a safety precaution, just to make sure that we're not thinking of a product being over productive when it might not be. So we do take that into consideration. But the power of indexing is no bad returns, only good returns, and we avoid the negatives and we avoid the losses in the bad years. The third thing would be tax-free distributions. Now with IRAs, every dollar we ever take out of them is taxable, both what we put in, what our companies may have contributed into our 401ks, plus everything it ever earns. The IRS is your partner in the ownership of that product. People look at it and say, I have $500,000 in my IRA. No, you don't. You have $500,000 minus what you owe to the IRS. And that could be anywhere from 15% to 30% of that money belongs to the IRS. If you have a Roth IRA, you've already paid the taxes on the contribution, and all of the growth is tax-free, and your income is tax-free, and it's tax-free to your heirs. The same applies to the indexed universal life policy. As we put money in and it accumulates cash value, then the death benefit is tax-free to our heirs, but the income that we take in the form of loans from the policy comes out tax-free. So I have the legacy benefit, I have the power of indexing in the good years and bad years, and I have a tax-free distribution of my assets. Third thing, you can access the funds with no market value adjustment. Market value adjustments come into play with certain annuity products where the bonds that insurance company bought to act as a guarantee on your investment in that annuity might be worth more or less than what they paid for them. If it's worth more, you could get a market value adjustment where your cash out value is higher than it says on paper. If the annuities, the bonds are lower, you actually could end up having more discount if you cashed in the policy earlier because the bonds were lost in a market value adjustment, in other words. With the life insurance, and especially the index universal life insurance, we don't have that problem. The other benefit that isn't mentioned here is that there's no 59.5 rule. There's no 5-year rule that applies to Roth IRAs if you're pre-59.5. There's no 59.5 rule like there is with IRAs and 401ks and things of that nature. If I have money in there, if I use this for my children to build up a cash value program for them, they don't have to wait until they're 59.5 to be able to access those funds. So that's a pretty big deal. The third thing is that there could be additional benefits for medical cost and aging. If I put, over a 5 or 10 year period, if I put $200,000 into a Roth and I need to go that money to pay for a nursing home, it's worth $200,000. That's what I can get out of it. If I have an IRA, it's worth $200,000 minus whatever the tax man wants to take. I put the same thing into an index universal life policy. It may be worth $400,000 or $500,000, which I can access to help offset the cost of a nursing home, which I cannot do. With the Roth or the IRA or the investment, it's worth what it's worth. I'm spending my money. This way, I'm looking at the ability to pull more money than my money out to use for chronic illness and things of that nature. So there's an awful lot of benefits going on there. A couple other things I looked at, just looking at the power of indexing. If you'd have put money into the S&P 500 in 2000, and kept it till 2010, you would have made a negative 1% average rate of return. Now we forgot about that. Okay. Now, if I look at it over a 20-year period, a little bit different. This is the 20-year cycle. Here's that first 10 years. And then this is the last 10 years. Now, this is what we've gotten used to. We had some dips in there last year, but this is what everybody anticipates happening. We forget about this part. Now, the pitch is always, well, look here, if you'd have just hung on, you'd have averaged 6% over that time period. Great if you're 30 years old and planning on retiring in 30 years. But what if you're 60 or 70 and you retired back here and you're having to spend out of these pockets? Wouldn't that be a completely different situation? The power of indexing gives us this potential. The green line is the indexing with a 10% cap. Now, we don't necessarily use caps all the time. Some products I like to have no cap whatsoever, but it's easy to explain this type of structure. This is using the S&P 500 with a 10% cap and a floor of 0. You see what happened in the negative years right here? We stayed absolutely flat. You didn't make a nickel for 2 or 3 years there. Then when the market started back up again, even though it hadn't gotten back above even from our start point, we made new money. New money, new money, new money, did not lose, made new money all the way up. Now, the last 2 or 3 years where we had the huge run-ups, especially in 2020, then yes, the market outpaced us. But if I had been retired back here and living out of that money, which line would you rather have lived out of? Which one would you rather have been taking income from a comfort standpoint? And granted, not all your money belongs in this type of a situation, but using the index products, whether it's in the annuity format or in the index universal life policy, in my opinion, there's some pretty major benefits if you can qualify and if they fit your particular situation and as a part of your overall plan. So that's my part of the program tonight. I just wanted you to have a little bit more food for thought. One last thing. If you really like the idea of this program, but it might not fit you personally, think about what this would do for your children. What if, especially if you're going to gift to them anyway, this would be a really great way to build up a program for them to have huge amounts of tax-free retirement, a guaranteed death benefit for their heirs, and also the potential to draw money out during their 40s, 50s, and 60s if they need a car, a house, a business, whatever. They might as well use their own money instead of borrowing it from somebody else. So very, very good plan, and we'd be very happy to talk to you about it if you have an interest.
You had a question in there, Mel. I'm not sure if you saw it.
Why don't we come to that one? Why don't we come to that at the end and we'll do all the questions at one time.
Okay.
So we'll go to that. And then I'm going to just talk for a little bit, current events. Right now, we get a call at this time quite a bit. 1099s, when will they be there? The 1099s for individual accounts are basically out on 2/13. So they should have went out last week. Should be arriving soon. If you're waiting for a consolidated 1099, which takes 5 or 6 or 2 brokerage accounts and combines them together, those are not going to be available till around February the 27th for Fidelity. A lot of people have asked me why that is, and it was predominantly due to the fact that 1099s by law were supposed to be out by January the 31st. And what happened is the mutual fund companies, when they paid out dividends or they had capital gains, a lot of times they did shifts between what was a long-term capital gain and a short-term capital gain. So therefore, they had different numbers. And when they put out the 1099 on the 31st of January, they had to be amended. And people weren't real happy when they filed their tax returns and then had to turn around and file an amended tax return because short-term and long-term capital gains had different amounts. So that is one of the main reasons why you get a late 1099 for your brokerage accounts. If you have a Fidelity, TD Ameritrade, you can log in to get those. Some people have them mailed, some people don't, but they are available to everybody online. And for the accounts that we have access to, we would be able to assist you that if we needed. But we cannot, if you got a retail Fidelity account, we don't get the 1099 or the 5498 for that. So you would need to look at that yourself. Now, the other thing that everybody found out about was 2/13 was the day that you could do your taxes. The government was about ready to receive those. One of the questions that has been coming up is, okay, I got the stimulus payment. What do I do? Well, the problem is the stimulus payment is not a taxed event, but you have to put it into the software. You should have got, if you got one, the first one, you should have gotten an IRS notice 1444 for the first stimulus that was sent back a long time ago. The second stimulus was sent sometime in December. You'd get a 1444B. The problem of it is if you tell the computer you got a stimulus check, they're going to want to know the exact amount you got in your stimulus check. And what's the total amount for both spouses? And if you have children, them too. Those numbers need to balance. So if you got a stimulus check, please be careful when filing your returns so that you make sure that you've got all of the information that's possible. Again, we don't do taxes. I just try to follow up with the rules. If you got any questions, you can give me a call. If you're looking for somebody to assist you with your tax returns, please give me a call and I will give you the name of some accountants that can do that. We as an office currently at this point do not do taxes. The other thing that I came up was I was reading an article on Forbes. And a gentleman from Forbes, they had somebody that went out and he went to 3 different Social Security offices and asked about filing for Social Security. He got 3 different amounts on how much he could get from Social Security. So he ended up going back to the one that gave him the highest amount and said, I want to file here. And then the question gets asked to me, why would there be possibility of 3 different amounts? And the main reason for that is the IRS is only allowed to answer the question that you ask. So therefore, if you ask the question wrong or differently between 3 different Social Security people, you're going to get different answers because you didn't, it's the way you ask the questions. And that's why we like to say a lot of people think Social Security is real simple. You know, I get 62 years old, I can file for my Social Security. And then I'll ask one question that I doubt if we had everybody on what day of the month would you have to have been born so that you could start Social Security at age 62? Wait a minute, we're all allowed to start at 62, aren't we? The answer to that, the only person that can file for Social Security at age 62 is somebody that was born on the 2nd day of the month. Because if you were born on the 1st, you were actually 30 days the month before. If you were born on the quote 2nd, you were 62 for the entire month. So you can file Social Security. Almost everybody that files Social Security thinking at age 62, it actually happens at 62 and 1 month. So there are a lot of different things with Social Security. We have the software that we can put your dates of birth in. We can put in what your benefits are predicted to be, and then we can look at it and say, when would be the best time for you to file for Social Security? And we can print out the stuff. And then you can actually call the person at Social Security and say, I want to start my Social Security benefits at 62 and 1 month. Because you can't start it at 62 because you were born on the 10th. So we give you that information that makes it a whole lot simpler. And that's like I said, most people think it's just I'm going to turn a certain age, turn it on, and it will happen. It's more difficult during the pandemic. because of the fact the customer service departments in so many businesses, including the Social Security Administration, people are doing it from home. So they don't have that supervisor around there. When you make that phone call, you might get the person that's been there for 6 weeks or the guy that's been there for 16 years. So if you want some assistance with your Social Security, please don't hesitate to give us a call. Again, we don't do taxes. I can't file your Social Security for you, but I can give you the right questions to ask when you talk to the people in the Social Security offices. Again, I would like to say thank you all for being here. I would like to thank the people for the referrals. We've been continuing to get the referrals, and our goal is to do business with people like you. So if you know somebody that we might be able to be of assistance to, please don't hesitate to let us know. Had somebody call the other day and they said, well, I got somebody that's about 60 and they're not planning on retiring until they're 65. Should I have them give you a call? We say absolutely yes. As many of you have experienced, you've saved for retirement or you wouldn't be talking with us. If we could possibly switch the way you're saving for retirement to make it more tax advantage in the future, it could be very advantageous. So again, thank you all very much. An easy way to do the referral is to send this. Those that are watching us live, you will get a copy of it later. And if you watch it from our website, please don't hesitate to forward it on to somebody else. And again, thank you very much. If we created a question, that's fantastic. Please take the time to give us a call, and we look forward to talking with you.